Hi, my name is Rod Cleef, and I'm the host of the Lifetime Cash Flow Through Real Estate Investing podcast. And every week I interview multifamily rock stars, and we talk about how they've built incredible wealth for themselves and their families through multifamily properties. So hit the like and subscribe buttons to get notified every Monday when a new episode comes out. Let's get to it. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Cleef, and I'm thrilled you're here. And I'm super excited about my interview today. It's a friend of mine, Paul Moore, who was on the show, about when I started this thing back in 2017, I believe. And Paul has been involved in all sorts of different asset classes. He's in multifamily, he's in mobile home parks, he's in self-storage. He's got his own podcast called How to Lose Money, which is an awesome title. I think I was on that show once. Yeah. And yeah, I was. Okay. Yeah. So anyway, and he's interviewed all the time, and I'm excited to have you here, brother.
Man, it's great to be here. Thanks, Rod.
Yeah, you bet. So maybe you could just elaborate on that pathetic history I gave on you, and just talk a little bit about your history and what you've done and what you're up to, and then we'll take it wherever we want to take it.
Fantastic. Well, I worked at Ford Motor Company for 5 years, and then I had my own company 5 years. I sold it to a publicly traded firm in 97. And Rod, I thought, I'm a full-time investor now. Ooh. And I thought, I am going to be like this cool investor, put it on my business card, but I wasn't. I found out later I was a speculator through and through. And, I found out the difference between investing and speculating. Investing is when your principal is generally safe and you got a chance to make a return, like a lot of the stuff you do in the real estate realm is in that realm. And then speculating is when your principal is not at all safe and you've got a chance to make a return. And I swung for the fences, I played double or nothing, and I lost a lot of money. And I made a lot of money too, but I found out the difference between investing and speculating as I got into flipping houses, flipping waterfront lots, did some ground up construction. Bad idea to be a builder if you don't know how to build, but another story. I was trying to figure out over those years how to get involved in commercial real estate. And about 10 years into that, we built a multifamily facility in North Dakota for the Bakken oil boom, did another one next door, did a Hyatt hotel, which didn't go as well as the multifamily. And so I decided to stay in multifamily. Last show I was on, we talked about my book, The Perfect Investment. Right. And that was about apartment investing. And that's still selling pretty well. And since then, like you said, I've diversified into these other asset types. So fantastic. Well, before we started recording, we chatted about where we might take this today. And it's been a long time since I've had my friend Kevin Bupp on the show, who's got his mobile home park podcast, and we've talked about mobile home parks. So I think let's talk about mobile home parks today. It's been a while, and I think my listeners, it's absolutely multifamily. It's a different type of multifamily. So let's talk about, maybe a case study of a deal you did. But what I'd love to do is outline the potential benefits and the potential pitfalls. And I happen to know them because I studied mobile home parks for a long, long time. I never pulled the trigger, and I should have, but I didn't. And so I know a lot about the asset class, but let's have you tell it. So take it wherever you want to take it. Yeah, absolutely. Well, when I had a little cash back in like the late 90s, I looked at a mobile home park and I thought, I wouldn't want to deal with all of the hassles there. I'm glad in retrospect because I would have been a mom and pop operator. Mom and pop operators are what makes this such a great business. And here's why. There's about 44,000 mobile home parks in the US, and very few people have even officially counted that number. So they're not sure exactly how many there are. But about 85 to 90% are run by mom and pop operators, which means it's a very fragmented industry. Now, unfortunately, 93% or so of large apartment buildings are run by companies, and often, not always, often those companies leave very little value on the table. They've done the dog parks, they've done the upgrades and all that. And Rod, you're an expert, and you and your students are experts at finding those deals that do have intrinsic value, that do have money left on the table. But I honestly didn't find that. When I was in the apartment realm, I wasn't doing a good job finding those. But in the mobile home park realm, it's very hard not to find those because, like I said, over 85% are mom and pop operated. That means these operators don't have the desire or the knowledge or the skills or the resources to upgrade their parks and increase income and maximize value. Rod, let's face it, they don't have to. Cap rates have already compressed to the same level of the rest of the commercial world, including apartments and self-storage. They've already compressed so much, and these people are getting offers for literally double or more than double what they ever dreamed they could get, right? Even just staying mediocre. And so a lot of these they're not all mediocre, of course, but a lot of these mom and pop run mobile home parks can be acquired, and there's a lot of upside left. Now, some of the reasons this is such a great asset class is the tenants are really sticky, which doesn't mean they wear Velcro suits, though I'm not one to judge. The tenants typically stick around. If you raise their rent, let's say it's a $300 rent and you raise it by 4%, what's that? $12. So you raise their rent by $12. What are they going to do? Spend $5,000 or $6,000 to get their home moved down the street to save $12? Or if you raise it 10% by $30. Again, we're not trying to gouge anybody, but what I'm saying is people generally don't move these homes. 93 to 97% of the homes stay where they were originally placed. They're not really mobile. So the tenants are sticky. Number two, a Princeton study said mobile home park rents have not kept up over the last 5 decades with other types of rent. So they are often underpriced. A lot of times the mom and pop owner lives in the park. They're friends with the people. They don't want to raise rents. Another thing they don't want to do is they often don't fill vacant spaces. It's a pain to fill a vacant space. And often these are already cash cows. And so they're like, somebody moves out, or maybe a tenant, destroys or burns down their trailer. Well, they just leave it vacant. Well, that is a huge potential upside for a buyer. Another one is utilities. Believe it or not, a lot of these mom and pop owners, Rod, pass the utilities. They don't pass the utility costs back to the tenants. They pay them. There's huge upside in that. And so mobile home parks, according to the studies I've read, are the only asset class that have a diminishing supply and an increasing demand every year in the US. Yeah. As you and I think we might have talked about this before, 10,000 people turn 65 every day, but about 6 in 10 don't even have $10,000 saved for retirement. A lot of them can afford to trade in their home equity, though, for a mobile home park lifestyle where they get their own yard. They get a short walk from their car to their door. They don't have to share a wall with somebody, especially during these pandemic times. People value that. And they get a place for their grandkids to play. And they've got the flexibility now to travel and a very, very low cost compared to other forms of home ownership or even some leasing. So it's a great asset class, and we're really glad to be investing in it.
No, I love it. You were talking about the official count. It's funny. Again, it's triggering some memory for me. At one time, I had 8 virtual assistants. 6 of them I was only paying $1.93 an hour, and they were happy to get it. These were Filipino, and what I had them doing was literally going on Google Earth and identifying mobile home parks because they're misclassified all over the country. Yes. They're hard to find. And so literally I had them working full time on this, and they would put geocoding over the top to find out who the owners were. And we did we created lists in almost every state, and just never pulled the trigger with it. It is kind of and they're not building it. Nobody wants a mobile home park in their backyard. And
right.
The opportunity to have one built is like nil. And you're right. They're not going to move. You could raise the rent more than that. They can't, most of these people can't pay $5,000, $7,000 to move their home. You can get a lot of hate. I know that, I know operators that have raised the rents too much and they make the cover of the paper. So you've got to be realistic and reasonable. But yeah, And so do you still believe it's still 85% mom and pop, or do you think that's shifted because it's been, been a high demand? I know, the guys over at Bigger Pockets, my friend Brian Murray and Brandon,
Brandon Turner. Yeah.
Brandon Turner, they're into mobile home parks as well now,
Yeah.
In a big way. And in fact, I shared my list with them actually. Brandon's a friend, and so is Brian. So do you still believe it's that high, or do you think there's that many mom and pops left?
There's going to come a day, just like the day the last World War I veteran died, years ago, when the mobile home parks, the better mobile home parks are all gone. They're snatched up by professional operators. And of course, when that day comes, or even approaching that day, we'll be looking at other asset types like RV parks, which we already are. But no, I don't think we're anywhere near that. I mean,
okay.
We, speaking of the misclassified, I was part of a 200 lot mobile home park acquisition in Fairbanks, Alaska. It wasn't even on Google Earth. It was actually misclassified on Google Earth as an RV park and sand and gravel pit.
Wow. Wow. Yeah. Anyway. I mean, what my VAs would do, again, I had 6 of them working for under $12 an hour. That's the power of virtual assistants, but they would literally fly around. Excuse me. I've got something in my throat. They would find a mobile home park, and then they would fly around in the air and look for others just by identifying the mobile homes. And then we would geocode them, find them, and list them. And we'd find mobile home parks that weren't on any list. And it was a very powerful way to do it. Let's talk about the potential pitfalls with mobile home parks. Yeah. Something that you've got to watch out for, because I know a lot of them are dated. So you want to speak to that a little bit.
Yeah. So the one in Fairbanks, Alaska is a good example of that. I mean, the mobile homes were all brought in during the, what was it? The pipeline. Yeah. The oil pipeline. Mm-hmm. I'm forgetting the name of it, but the Trans-Alaskan pipeline. The Trans-Alaskan pipeline, was built in the late 70s when you and I were kids. Those were all brought in then, and they were rough. And that made me nervous. I mean, it's literally the coldest city in America. So that is certainly a potential downside, because in Alaska, it's very hard to replace those homes. I mean, for the 50 vacant lots in that 200 lot mobile home park, it's very hard to replace those. So that's one. Number two, I mean, a related one right now, it's very hard to get mobile homes in general. The COVID supply and demand crunch has caused it to be sometimes 8 or 10 months, even for experienced operators, to get mobile homes. If you've got to fill 50 slots, one per month, you might be waiting 8 months to get your first one. And so that's another potential downside. Another one is, one of the upsides is what you said, and that is the cities and counties aren't allowing more, which helps supply and demand. I mean, for the people who are in the business already. But a downside is they might do everything they can to oppose you. Mm-hmm. So, like, for example, if 5 of your lots have, the homes hauled away, like the place I was mentioning earlier in Fairbanks, the local authorities might try to make it difficult for you to put new homes on there. In other words, they'd like to see you go away.
Right.
And sometimes they even cut deals with developers. Like, look, you take that mobile home park out and you open that up for apartments, and we'll let you have this development. It's kind of a deal they try to cut at the zoning level.
Wow.
Yeah. So that's another downside. Another one is the bad press. Now, this is a really interesting story. We invested in a deal in New York State. New York is one of these states, as you can imagine.
I won't step foot in there as an investor. Blue states in general. I mean, it's not a political thing. I just, why deal with all that regulation? It's brain damage. I get it. Low hanging fruit elsewhere. But anyway, I'm sorry I interrupted. Please continue.
No, I get it. We don't step foot in California. Right. So for the same reason, even though I've got 2 family members there. But okay, so this operator was raising rents on mobile home park pads 1% to 2% a year, typically. And that's all they needed to do to fulfill their business plan. Well, the state of New York got mad at some mobile home park owners there, and they passed a statewide restriction that you could only raise rents on existing tenants 3% a year. If I'm not mistaken, I think it was 3% a year, unless there was inflation. Then you could apply to go up to 6% a year. Well, guess what? He was only doing 1 or 2% as it was. I think he said he averaged 1.5. Now he said, well, since everybody knows the limit's 3 a year, I just went up to 3. So he's actually making more money from this downside. But I don't think it would always work that way. Now, when he brings in a new tenant or a new mobile home, he can do it at market rates, it's the current going rate, of course. Okay. Other downsides are, investors been looking down their nose at mobile home parks for years. But I would say this: live where you want and invest where it makes sense. And for a lot of people, this makes sense.
Oh, no question. Well, there's some other downsides I want to mention. Yeah. A lot of these parks have antiquated systems for utilities. Like maybe they've got a sewer plant, or they have a pond is even worse, where they've got a sewer. Literally, it's a lake that they dissipate sewage into, or they're on like maybe one well, one septic for numerous homes. That's very dangerous. And so, that's an area that you want to be really, really careful if you're looking at a mobile home park. If it's got a sewage plant, you better have somebody who knows what the heck they're doing, evaluate it, and look at the remaining life. Because if it goes out, your park's out of business. And so that's a real problem. And if you're on a well and that well has a problem, you've got a real issue. And I know Kevin, my buddy I was mentioning earlier, that's got a mobile home park podcast, he always has a secondary option, like city water, city sewer. He budgets that in the event he has to have it as like a fail safe in situations like that. And so at least that's how he used to operate. It's been a while since I've talked to him about this, but so the infrastructure is another area you want to be really careful that you're not going to encounter that with multifamily so much. Yeah, you might get some, some piping that needs to be replaced, or sewage, that's got roots in it, whatnot. But you're not going to have like some of these sewage plants are extremely expensive, like 100,000 plus. So that's a factor. The other thing, and I don't know, just out of curiosity, because again, I've been so far removed from this for about almost 5 years now. What about the insurance risk? Because I got to tell you, I remember when Hurricane Charlie hit Sarasota. I'm not Sarasota, actually Port Charlotte. And I was the largest single family homeowner down there. I had about 360 houses down there. And it was like a bomb went off. But where it really looked bad was the mobile home parks. I mean, you don't survive a storm like that in a mobile home park. So, and tornadoes and things of that nature. In fact, I had a tornado hit one of my apartment complexes and destroy it. But I mean, that sort of a storm to a mobile home park is devastating. Can you insure around that? And if so, what does that look like? I'm just curious.
Yeah. So the best run parks, as to your earlier point, are on public water and sewer usually. And that's why I think people need training. And that's why the stuff you do for apartment owners is so valuable, because I get these questions on Bigger Pockets all the time. Hey, this mobile home park down the street went up for sale. I think I'll buy it. And it's like, but they don't even know at all. They're like, what should I learn? Well, it's like, don't buy it, first of all, because you need to go get some training, pal. But anyway, try to be nice.
Right. And you need, like if it's under 40 spaces, you're going to manage it. Okay.
Yeah,
and so I can't even think of more brain damage than you could possibly imagine than doing that. So, I get students that are like, hey, I can buy this 20 space park. I'm like, listen, unless you've got some sort of a management solution, I would run for the hills.
Yeah,
but
good.
Yeah.
So, but I mean, so in the same way, a professionally managed park usually, not always, has a vast majority of those mobile homes in the names of the individual owners.
Just lot rent.
So, so they're pretty much leasing infrastructure. By the way, we should talk about the tax benefits of that later. Okay. But anyway, the infrastructure, leasing the dirt, the sidewalks, the curbs, the gutters, the parking lot, the street, the pool, the community center. Those things, again, are not typically as damaged by a hurricane, as you know. But if you lose all your tenants, that's a real problem. So we like to see, operators get business continuation insurance, where they'll be insured for let's say 18 to 36 months while people, if those things get destroyed. But that is definitely a risk, especially with a supply and demand issue with getting new homes out there to replace the old ones. But of course, the individuals should have their homes insured. And of course, they may not.
Very often they don't. But this 101 unit complex we have in Beaver Creek, Ohio, I get a call. It's like, it's been destroyed. This is just a few months after we bought it. Luckily, nobody died. A couple of people had to have surgery. No kids got injured, thank God. But all 101 families had to move. Now, the positive to that is, we rebuilt it and we got $650 rent bumps, which is a $12 million instant increase in value. So, there's a positive to that, but it was a bit of a nightmare dealing with it. And when I dealt with Charlie here, not to digress too far, it took us 18 weeks just to assess the damage. Forget getting going on it. There were people here without power for months. It was insane what the impact of that storm was. But one of the hardest things I've ever had to deal with. But anyway, so those are the pitfalls. We talked about the advantages. Now, financing is another pitfall, correct, with mobile home parks, because it can be more challenging to get financing on a park. Can you speak to that a little bit?
Yeah, professional operators are now able to get these almost exactly the same Fannie and Freddie agency debt that you're getting for apartments. And so that one thing that's helped with that is Sam Zell, America's largest and arguably most successful real estate investor. He has 158,000 mobile home park pads, a lot of them in your state.
Wow.
And as a result, he's made it very common, he's institutionalized mobile home parks, if you will. And so, financing is fantastic. In fact, some of the Fannie Freddie debt comes with two potential refinancing opportunities in the all the way up till 5 years before the end of the term. So if it's a 12-year term, you've got 7 years. You can refinance twice at the same rate to pull equity out for the.
It gets called a supplemental with the Fannie program, right? Now, back when I was evaluating this, I know that to do Fannie, you had to have curbs, you had to have paved streets, and a lot of mobile home parks have, don't have that. I don't know if that's still the case or not, but there are some, for conforming loans like that, there are some restrictions, I'm sure, still. But okay.
Well, and one of the cool things about this, a lot of the mom and pops think, I can't sell my place. I'll have to owner finance it. I don't want to owner finance. And when you come in as a professional operator and say, no, you don't, you got an edge.
Okay. No kidding. Well, that makes sense. Wow. Okay. Well, so that's mobile home parks, guys. Now, again, I wouldn't buy anything under 40 units. I would make sure you check the infrastructure like we just discussed. Ideally have public water and sewer. Make sure the electrical is not horribly out of date. And you'll find parks where a lot of the homes are park owned, and that is the lowest. I want to be careful how I articulate this. That is the toughest demographic you're going to encounter as a renter, okay, as a landlord. And so, I'm going to tell you that those homes get beat up. Very often they need a lot of work. And the ideal business model is typically, correct me if I'm wrong here, Paul, is to take a park like that and start converting those to lot rent. Try to get people to buy those homes and put them on lot rent. Would you agree with that statement?
I'm suppressing a smile because I like to say that my worst 3 investments ever were in mobile homes. Yeah. My best investments ever have often been in mobile home parks. Right. And those parks run by a professional property management team always do what you said. They always try to convert the park-owned homes away from park ownership to the individual tenant ownership. You're absolutely right.
Right. Okay. So I know you're also in self-storage. Now, this is a multifamily podcast, but let's take a few minutes and talk about why you like self-storage. And I know that you've got a book now. Is it on Amazon?
Yeah, it's on Bigger Pockets and Amazon. It's called Storing Up Profits.
Right. Storing Up Profits. So talk about what you like about self-storage. I've got students that have thousands of self-storage units as well. I have not put my toe in that water yet, but my partner has done a bunch of it also. Tell me why you like it.
Well, I'll say one thing that I think multifamily operators and mobile home park operators should consider adding some self-storage to the vacant land if they can't get approved for more apartment units. So,
Yeah.
I mean, it doesn't take up any parking.
We actually were looking at that. Yeah, we were actually looking at that with an asset we have in
Great.
San Antonio. We haven't pulled the trigger on it yet. But anyway, continue. Okay.
Yeah. So real quickly, they're recession resistant. The COVID the self-storage has come out of COVID as the top performing asset, according to the New York Times and Wall Street Journal. The prices of the rents are inelastic. I mean, if I'm renting $1,000 a month apartment from you, Rod, and you raise the rent 6%, I might, leave before probably in these days I wouldn't, but right. In general, I might leave before I commit to another $720 a year. But if I'm renting $100 month to month self-storage unit, you raise it 6%. I'm not going to spend a weekend, get a U-Haul, my friends together to move my my treasures down the street to save $6 a month. There's a high switching costs. Like I said, moving the stuff, it captures inflation well. Since it's a month-to-month lease, you could actually raise rents 12 times a year. They're fragmented as well. About 3/4 of the self-storage units are owned by independent operators. 2 out of every 3 of those are mom and pops with one facility. One thing I really love is the fact that a lot of mom and pop owners just view these as little metal boxes that spit out cash. They view it kind of as a passive investment. But really, to do it well, you need to be actively involved, getting the value adds out, selling locks, boxes, tape, and scissors, and renting U-Hauls out of the front if it makes sense to, adding units, taking that 6 acres in the back and progressively graveling or paving it to put boat and RV storage. There's a lot of work in doing it right. And this is what we love about this industry.
Interesting. All right. So again, the book is Storing Up Profits. Paul, it's great to see you, brother. I really appreciate you coming on the show and sharing some wisdom. It's been a lot of fun going a little back and forth on this. And so mobile home parks, self-storage, and I know you've done multifamily as well, but this is fun to talk about something else on the show. And it's good to see you, my friend, and let's stay in touch, buddy.
Great to see you as well. Thanks, Rod.
Take care.
Rod, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. Now, I know you've been hard at work helping our Warrior students do just that using our ACT methodology, which is awareness, close, and transform. Can you explain to the listeners how they can get our help?
You bet. Guys, we've been going nonstop for 3 years, building an amazing community of like-minded people. And our coaching students, which we call our Warriors, have had extraordinary results. They've purchased thousands and thousands of units. And last year, we did over 1,000 units with our students. And we're looking to grow this group and take it to the next level. We're looking for people who want to follow a proven framework that's really step by step, and then leverage our systems and network to raise equity, to find and close deals, and to build partnerships nationwide. Now, our Warrior community is finding success in any market cycle. So if you're interested in finding out more about how you can become more of our incredible network and take advantage of the incredible opportunities that are coming very soon, apply to work with us at mentorwithrod.com or text CRUSH to 72345, and we'll set up a call so you can check us out and we can check you out. That's mentorwithrod.com or text CRUSH to 72345.